All right, so you know how everyone's eyes are glued to the stock market, right? Well, while that's happening, something way bigger, something foundational, is flashing some serious warning signs. We're going to break down what's going on and, more importantly, why you should care.
So the big question is, where is this warning actually coming from? The headlines are all about the S&P 500 or the Dow Jones, but the real story, the one that could have much deeper consequences, yeah, that's playing out in a completely different arena.
And the short answer is, nope, not even close. Look, stocks are noisy. They jump around based on tweets, headlines, you name it. But if you listen closely, underneath all that chatter, there's a much deeper signal. And that's the one we really need to tune into.
And that signal? It's coming from the bond market. We're talking about the $30 trillion US Treasury market. This isn't just some other corner of finance, it's literally the bedrock of the entire global system. And when that bedrock starts to show trouble, well, historically, that's a sign that a much bigger economic storm is brewing.
Okay, so let's get specific. What do these cracks actually look like? There are three big symptoms that are showing up right now.
First up, yields are shooting up. A yield is basically the interest rate the government pays on its debt. So when the yield on something like the 10-year Treasury goes up, it's a big deal. It means investors are getting jittery and they're demanding a higher payout to take on what they perceive as more risk.
And get a load of this. The 2-year Treasury yield, which is super sensitive to what the Fed is doing, jumped by 0.62 percentage points in a single month. That is its worst move since September 2022. That's not just a small change, it's a huge, rapid shift in market sentiment.
Symptom number 2. Things are getting really volatile. You've heard of the VIX for stocks, right? Well, the bond market has its own fear gauge called the MOVE Index, and it has spiked to levels that we've historically only seen during times of serious instability. So you've got higher borrowing costs and more choppiness. That combination, it's a really dangerous cocktail.
And that brings us to the third symptom. And honestly, this might be the most worrisome of them all. Liquidity, the very grease that keeps the gears of this market turning, is starting to dry up.
So, what exactly is liquidity? Think of it this way. In a liquid market, you can buy or sell huge amounts of stuff without rocking the price. It's smooth. But when liquidity disappears, it's like trying to drive a car with no shock absorbers on a bumpy road. Every little bump becomes a massive jolt. The market gets fragile, and it's suddenly prone to these wild, sudden swings.
And the numbers here are pretty shocking. A key measure called market depth has dropped by as much as 40 to 50% in some areas. Let that sink in. 40 to 50%. That's a huge sign that the fundamental plumbing of our financial system is really starting to creak.
All right, so the big question is, why? What's behind all this stress? Well, the analysis we're looking at points to two main culprits.
Now, according to the source material, this is a two-part story. First, you've got geopolitics. The war in the Middle East is creating fears about oil prices, and that stokes worries about inflation coming back. And second, the source highlights policy uncertainty, suggesting that unpredictable moves from the administration are making global investors nervous and eroding their trust in the U.S. financial system.
And look, this isn't just some niche theory. Big names on Wall Street are sounding the alarm. When a heavyweight like Morgan Stanley comes out and says the market is near an inflection point, a turning point, that really tells you we're at a critical moment.
Okay, so we've been talking about yields and liquidity, but why should you actually care about any of this? Because this isn't some abstract thing happening on Wall Street. The stress in the bond market has a direct, real-world impact on all of us.
Let me walk you through how it works. It's like a chain reaction. It all starts with that unstable Treasury market. See, Treasury rates are the benchmark for pretty much every other loan out there. So when they go up, so do your mortgage rates, your car loans, business loans, everything. And when it costs more to borrow, what happens? People and businesses pull back on spending. That, in turn, slows down the whole economy. We're talking slower growth, maybe fewer jobs. It's a perfect example of how a crack in the foundation can end up shaking the entire house.
So this all brings us to the final takeaway. When you boil it all down, what is the bond market really trying to tell us right now?
If you filter out all the noise, all the numbers and the jargon, the message becomes incredibly clear. And it's just one word.
Urgent. That's the message. The market is screaming that something fundamental has shifted and it's happening fast. Investors are basically reevaluating what risk even means in this new environment, and they're demanding to be paid more for it. This whole thing, it's not just a bond market story. It's a flashing red light for the stability of the entire system.
And so, we're left with a pretty sobering question. The signals from the foundation are unmistakable. The cracks are there for everyone to see. The question is no longer if the rest of the market will feel the effects, but when. And just how bad will it be?